going on, you guys? It's Brandon, and today we're going to be talking about some options trading basics, some things you need to know, some things you may have questions over. But before we get into the specifics of the video, if you guys would like to like the video and subscribe to my channel. I'm a finance channel covering anything under the finance umbrella, whether it's considering the stock market or Fed news or anything in between. I'm looking to cover that. So for future videos, if you want to watch them, make sure to subscribe. Okay, so the first thing we're going to be getting into when it comes to options trading basics is what are calls. So a call is just an agreement between you and the seller of that call to buy shares at that certain price. So to give you an example, say a stock is at $100, but you believe it's going to go to $110, you'd want to buy the 110 call for whatever expiration you believe. And now that 110 number is what they refer to as the strike price. And so that's just you saying you believe it's going to go above that mark. And now when you purchase this, you pay a price to get this contract. So let's just keep it simple terms. So for this 110 call that you're trying to buy, it's going to cost you 50 cents. But since every options contract is leveraged with 100 shares, you multiply that by 100. So you'd be paying $50 for a contract. And so that in turn means for you to break even by expiration on your contract, you need the stock to reach $110.50 for you to break even. So by expiration, for every cent it moves higher than that, you're getting dollar for dollar on your money. Now you could get even more than that, depending on if it moves faster than you anticipated or a number of different variables. But that's kind of the basic when it gets to coming into call. Now, a put is basically the exact opposite of what a call is. So in very, very simple terms, a call, you want the stock to go up, and a put, you want it to go down. It's a little bit more complicated than that, but in simple terms, that's what it means. So a put, say a stock is at $100, and you think it's going to go to $90. And so in that instance, you would buy a put for $90, and to keep it basic again, we'll keep it at a 50-cent contract. So you're going to be paying $50 for the entire contract. And so that means your break-even price is going to be $89.50. So any further down that stock goes, the more money you make. And so the reason why people buy calls and puts is, yes, 90% of the time they expire worthless, but when you are on the right track and you have a hunch on what's going to work, you can make a lot of money doing these things. Now, is it always the smartest thing to do all the time? Definitely not. If you do it irresponsibly, you can lose all your money. But if you dispatch it in the right way and you're able to really take advantage of the time when there's either low volatility or a number of different situations, you can really cash out and make a lot of money. But it's all about being smart and doing your research beforehand. And I almost forgot. The biggest difference between a call and a call, you have the right to buy, and a put, you have the right to sell. So those are the two different things. And now, if you guys have any questions regarding any of these, make sure to leave them down below, and I'll make sure to get to every one of you. And with that being said, don't forget to like and subscribe to the channel. Trying to make as many videos as I can for you guys, seeing if you like any different content, trying to get my feet off the ground. But let me just know what you guys want to see in the future. But with that being said, have a good day.